What's up, guys? Welcome back to another video. Thanks for tuning into Stock Essentials. If you're new here, consider subscribing. We make daily videos on stocks, options, and all that good stuff, the hottest stuff in the market. So today we got Orphazyme stock, and today they had a pretty good run up in anticipation of the action date for the FDA tomorrow. So Orphazyme is up 61% today overall, reaching highs of almost $24, basically doubling the stock price before having a bit of a sell-off. Because remember, every time we see a huge fast run-up, people are going to want to take profits when they see the stock double and their investment doubling in just a few hours. So that's what we're seeing here. But overall, it's still up a lot, 61%. And today they did just release an options for the stock. So we're going to be going over the best options that you should be playing on the stock if you decide to go that route. So let's take a look at the options chain. So we can see that there's not much going on here in terms of strike prices as well as expiration dates. It's very new to options. They just brought it out today because of all the volume. The average volume on the stock is normally around 8 million, but today it's over 170 million volume, which is absolutely insane. So they brought out the options chain for the stock because of how many people are buying into it. So as you can see, the highest strike prices is $15. Now, you can only buy in the money call options, which I thought was pretty interesting. And the lowest strike is going to be $5. For the put side, same deal, $5 to $15. And even if you go out to further expiration dates, there's really not much flexibility you can do in terms of the strike prices. As you can see here, every single expiration date, there's only 4 of them. They only have 5 strike prices for both the calls and the put side. So you don't have too much options for that. But as we can see, there's not much volume going on with these contracts, but implied volatility is pretty high. Options are pretty new, so someone has to be writing these contracts, and because there's not many people writing the contracts for these options, the premiums are going to be a little bit higher than normal. So it's kind of risky if you want to buy call options, if you want to buy put options as well. That's kind of risky. Premiums are very high, but based on what's going to be happening tomorrow with the news for their new drug treatment, it could be a good investment if you're willing to risk a little bit of money. And since all these are all in the money, the premiums are going to be a little bit expensive for for a $16 stock. So it's probably better to just buy shares, to be honest. But if you have a bit of money and you want to be a little bit risky, I would definitely choose this $15 call option rather than these other ones that are pretty far in the money now. But if you want to play options, it would probably be best to sell options. If you're holding 100 shares, you can definitely capitalize on selling some covered calls. The $15 strike would be the one you want to sell as well, collecting $770 of premium. So basically, if this stock stays below $15, you're going to be making the full profit of $770. The ideal situation, if you're selling a call, would be to hover just under the strike price. So you want it to stay maybe like $14 a share. Or if it's just slightly over, that's fine too. You're still going to be selling your shares at $15 each. But you are going to be collecting almost $800 of premium. So if it hovers around $16 by expiration, that's not that bad either. But my favorite strategy would probably be selling cash secured puts. As we can see, the premiums are pretty high. You can sell a $10 cash secured put for $258. That's because there's not much contracts out there, so we need people to sell these option contracts for the buyers, and then people are willing to pay a little bit more for these contracts because there's only a little limited supply being written right now. So a $10 cash secured put for $258 seems like a good deal to me. That's a 25% return in just 1 month, as long as Orphazyme stock stays above $10. That's pretty huge, because if we take a look at the stock itself, $10 range is a pretty good buy for the stock. It's been pretty stable at around $11, $12 throughout the past week, and as you can see, all-time highs, $32, and it hasn't really gotten too low. All-time lows was around $5, but it's been recovering since. So a $10 doesn't sound that bad. If you want to be a little bit safer, 7.5 strike. Guys, look at this. $123 of premium collecting as long as it stays above $7.50. And it's currently at $16.14. So it needs a huge drop in price for you to lose money on the stock. And if the stock goes under $7.50, you get to own 100 shares at that cost basis. And factoring in the premium, your new cost basis is going to be $6.27 per share. So basically, as long as Orphazyme stock stays above $6.28, as we can see here, this means we're going to be making money. Anything below that, we're going to be losing a little bit of money, but that would be a really good cost basis to own the stock at. So if you want to be a little bit risky, you could do the 12.5, maybe even the $15 strike. But personally, I would do the $10 strike or the $7.5 strike expiring July 16th, which is a month from now. So you're going to be collecting some really good premium off of these options by selling cash secured puts. But that's about it for this video. If it helped you in any way, please leave a like, comment down below what type of video you want to see. Do you want to see more option strategies? Do you want to see more stock analysis? Leave a comment down below. And of course, please consider subscribing if you're new to the channel. It helps out a lot. Thanks for watching.